Welcome to Forex Made Simple. In this video, I'm gonna cover everything you need to know about risk management. So we're gonna go through what is proper risk management and then the common myth about risk management. And then we're gonna cover the correlation of pairs in Forex. After that, I'm gonna give you a proper risk management strategy. Then I'm gonna show you how to use that strategy in real examples. When trading Forex, no matter how good your strategy is, you really never know whether your next trade is gonna be a win or a loss. So it's very crucial that you have a limit of how much you're gonna lose per trade. So that's where risk management comes in. Without having a proper risk management, it's very common that you might make a lot of money in one day or a week or even a month and then lose all of that money in one trade. So we don't want that. So the first thing that defines a proper risk management is having a percentage that you are willing to risk every time you open a trade. So for example, myself, I only risk 2% of my total trading capital every time I go in. This percentage depends on the kind of strategy that you trade, but I really recommend that you keep the percentage less than 5% all the time. So that is the first step. The second thing is that you're gonna risk that 2% in all of the trades. This means that if you are risking 2%, you'll have to lose 50 times in a row to blow that account, and that's almost impossible, because your first goal as a forex trader should be to last. So I've heard a lot of people misunderstand this concept of risk management. Most people think using the same lot size is risk management, and then others will say you should have the same size of a stop loss. For example, you should use 30 pips for every time you trade. And also I've seen people who don't consider correlation of pairs when trading, and I'm gonna explain why these are not proper risk management strategies. The main reason why using the same lot size or having the same size of a stop loss every time you open a trade doesn't work, it's because currencies have different pip value for the same lot size. Let's take a look at these two pairs. So starting with GBP USD. GBP USD is basically the value of Great British pounds measured in US dollars. And that means the unit of its price is US dollars. That means for every 10 pips of 0.01 lot, you're gonna get or lose $1. And then for every 10 pips of 0.1 lot, you're gonna gain or lose $10. And lastly, for 10 pips of 1 lot, you gain or lose $10 US. And that is because the unit of this pair is US dollar. And on the other side, GBP NZD is the value of Great British pound measured in New Zealand dollars. That means for 10 pips of 0.01 lot, you get 1 New Zealand dollars. And then the same goes on for other lot sizes. And again, it's because the unit of measurement of GBP NZD is New Zealand dollars. And we know that 1 US dollar is not equal to 1 New Zealand dollar. At the moment, 1 USD is 1.42 NZD. So from all this, we can see that having the same lot size or having the same size of a stop loss in these different two pairs will not ensure that you risk the same amount when you open a trade. And that goes against our definition of a proper risk management. So let's say you see a beautiful buy in GBP USD, GBP JPY, GBP NZD, and GBP CHF, and then you buy all of them. And at the same time, you see a beautiful sell in Euro GBP, and then you sell it at the same time with the other four, risking 2% on each. If you take a look at all these pairs, they all have GBP in them, which means they are all depending on what happens to GBP. So firstly, let's look at the buys. We have GBP-USD, GBP-JPY, GBP-NZD, and GBP-CHF. So for these buys to hit your take profit, GBP has to gain strength since you are buying. And for the sell, the euro has to lose strength against GBP, which also means that GBP is gaining strength against the euro. And that means for all these pairs, we're probably gonna have the same outcome. Because if GBP gains strength, all of them are gonna go your direction. And if GBP loses strength, all of them are gonna hit your stop loss. So this basically means we have risked 10% and not 2%, since all these pairs are essentially one trade. The good news is that we have a solution to this, and that is to divide the risk. So for example, if you see a buy on Euro USD and you see a sell on USD CAD, one thing you can notice from these two trades that I'm gonna take is that they are all dependent on USD. Since both of these pairs are correlated because they both have USDs, the solution will be to use 1% for each, so that we risk 2% in total. For this strategy, we're just gonna follow 3 steps. So firstly, you're gonna find an entry and note down the entry price. Then you're gonna calculate the size of the stop loss based on your strategy, and then we're gonna use a position calculator to calculate the lot size that we're gonna use to execute the trade, and then that's it. So let's say I'm buying AUD JPY and I'm gonna enter right here at the current price, and then my stop loss is gonna be down here. So the first thing I have to do is to note down the size of the stop loss, which is 13.8 pips, and that's almost 14 pips. So we know that we have a 14 pip stop loss on AUD JPY. So now we have to go to the calculator and punch in this stuff. You have to put in your account size. So I'm on $1,000 account, and this is just the percent that you risk every trade. So I'm gonna say I'm risking 2%, and then the stop loss is what we saw from the charts, which was 14 pips. So the contract size has to do with the type of your account that you have with your broker. So I'm on standard account, so it's 100,000. So you can check the contract size of your account. So I'm gonna say AUD JPY, yes, and then basically it's saying for me to risk 2% on this account with a 14 pip stop loss on AUD JPY, I have to use this lot size, which is 0.15. So let's take another example. Let's say I'm seeing this double bottom setup on USD CAD, and I've decided that I'm gonna put my stop loss down here. So, and that is 56.4 pips. To do that, I'm gonna use our strategy, which basically means find the size of your stop loss, which is 56 pips, and then let's go to the calculator and punch in the stuff. So this time I'm gonna use a $200 account, and then I risk 2%. This doesn't change, and then our stop loss was 56.4 pips, so I'm just gonna say 57, and the contract size is the same. We're still on a standard account, and then our pair is USD CAD. I'm gonna look for USD CAD.
and then it basically means we'll have to use 0.01, since that's the minimum lot size. So basically, for us to risk 2% on our $200 account with a 57 pip stop loss on USD CAD, we'll have to open that trade with a 0.01 lot. So I'm gonna look for USD CAD and say new order, and I'm gonna use 0.01. My stop loss is at 26970.